I want to welcome everybody to TradeStation today for this very special event that we have, this webcast that's being provided to us by Mr. Stan Freifeld, the Director of Corporate Services and an Options Mentor at the McMillan Analysis Corporation. Now, if that's the name of that company sounds familiar, Stan and Larry McMillan, the professional trader and best-selling author, are partners in a wonderful trading company. Larry McMillan is a registered investment advisor and commodity trading advisor, and he's been providing options-oriented advice, money management, and education since 1990. Known synonymously by the website optionsstrategist.com, the company offers a wide range of top-quality products and services for the serious options trader. Today, our presentation is about how to profit using delta-neutral options positions. Now, if you were considering options trading and using delta-neutral positions as a strategy, many professional and non-professional options traders use this strategy to increase their profits and reduce risk. It involves reducing or removing the position's directional component so that profits can be made regardless of whether the underlying security moves up or down. So sit back and take in Stan's knowledge today as we discuss the advantages and disadvantages of delta-neutral trading. I'm Don Prattle, the Director of Trader Development and Education here at TradeStation, and I want to welcome you and remind you that our presentation is for educational purposes only. All the symbols and trading ideas that we discuss here are for demonstration purposes. They are not recommendations. And this presentation is not an offer or a solicitation of any kind in any jurisdiction where a TradeStation affiliate is not authorized to do business, including but not limited to Hong Kong and Japan. Active trading is not suitable for everybody, and options carries a high degree of risk, and they may not be suitable for all traders. So please read the disclosure information in the PDF handout that I've made available in the chat panel. In addition, in the chat panel, I have included a link to the TradeStation YouTube site so that you can view our archived webinars. As you might know, our webinar today is being recorded, and we will post it in the chat panel in the next day or so to try to make sure that if you were taking notes and needed to fill in the blanks, Stan's presentation will be available to you on the YouTube channel. So here was the quiz that was posted on the screen prior to our presentation beginning. And I'm going to bring over Stan right now for the presentation on using delta-neutral option positions. So Stan Freifeld, please take it away.
Thank you, Don. Thank you very much for the introduction. And thanks for allowing me to speak to this group of traders. Normally, when I start a presentation, I give what some people have called a little bit of a sermon, talking about how tough it is to trade and you know, the pitfalls of trading options. And it is. It's difficult to you know, to make money without taking risk while we're trading options, or while we're trading anything for that matter. But I think this group knows that it's difficult, so I'm not going to go through my normal sermon. But what I do want to say is that coming to educational seminars like this one and other ones that you have at TradeStation, and that your customers who are using a Class A trading platform, you know, it's certainly going to help give them an edge over a lot of other traders who don't have the platform and the educational material available to them. So there's a big thank you to TradeStation for providing that. Okay, I'd like to get going with my presentation. I always start out, I have some riddles to get people thinking, because what I'm going to do, it's not going to be the type of presentation that you just listen to. There's going to be some numbers. And I'd like people to, as best they can, try and follow exactly what it is that I'm doing. You'll get the most out of it that way. And like you just said, Don, It'll be recorded, so if somebody misses parts of it and they want to go back, it'll be available. Okay, and by the way, the riddles at the end, I'll provide the answers to the riddles. I think it's one of the last slides that I have. But there are prizes, although I would imagine by now, I haven't checked my email, but I would imagine by now probably people have sent in answers to the problem. All right, let's move along though. There we go. All right, well, this is me, Stan Freifeld, Director of McMillan Mentoring. I have several other titles at McMillan, but that doesn't really matter. What matters today is that I'm going to show you how to profit with delta neutral positions. So here's an outline of the presentation. We've already covered the very first line, the warm-up riddles, but then I'm going to tell you a little about who I am. I'll show you a slide action and let you take a look at that. Don already went through a disclaimer. We have our own disclaimer, but so I'll go through that very quickly. But then we get to the real meat of the presentation. And what I'm going to do, I'm going to talk about the Greeks that we need for delta neutral trading. Now, the Greeks we need are delta and gamma, but I didn't think I could leave them out. So I also wanted to mention theta, vega, and rho. And we'll just talk about them for a minute. But then we'll talk about what a delta neutral position is. We'll define it. We'll say, why does somebody want to have a delta neutral position? How do you put together a delta neutral position? I'll give you an example. We'll see, does it really work? We'll talk about some of the problems, and I'll show you some of the tools that are available. And then I'll talk about some of the specials that we have at McMillan for those who are interested. There's some pretty neat stuff available. So we'll take a look. But anyway, let's go here. Wow, that's a picture of me when I had hair. I'm wearing my trading jacket from the American Stock Exchange. You could take a real quick minute, take a look at this. Basically, I was a market maker. I became a floor official of the Amex. I left on 9/11 for a number of reasons. I became a risk manager for a very large specialist firm on the New York.
Stan, if I could just interrupt briefly. Apparently your sound is low volume. If you could adjust your microphone so that you're projecting a little bit better. It seems as though I'm getting a number of comments about it. We just want to, straighten that out.
Sure. No. I don't have a control on my microphone though. Is there a way to do it through the software?
Well, it's turned all the way up on the software.
Yeah. Well, I'll just try talking right into it. Yeah, I'm not sure. Stan just needs to face the mic all the time. That's what somebody is saying. Yeah, I mean, I do webinars all the time. I'm not with this mic. I'm not exactly sure what the problem is. Do you hear me okay now? Don?
Yeah, you're fine with me. I hear you. Some of the attendees are not hearing you. I appreciate all the comments. If there are a number of folks that are saying they have no sound that I'm working with, so if you see those comments in the chat panel, that's who I'm referring to. Some of you that are in the room and you had low volume questions, I mean, that's also an issue. We're going to turn up the audio as loud as we can so that you can all hear it. Those of you that are having system issues, I'll continue to work with you.
Okay. Yeah, thanks for letting me know. I'll try to talk up also, but I'm talking right into the microphone. And like I said, I do this all the time. I'm not sure what the issue is. All right. Well, so here's the information about me. Enough about that. Here's my disclaimer. yours was fine. I think I'm covered, and McMillan is covered by that. We're not going to talk about any specific positions, so I'm not particularly concerned. All right, so let's get into it. To understand what delta neutral is, first we need to know the Greeks. And knowing the Greeks, the way I look at it, I liken the Greeks to the gauges in a car. If you don't understand the Greeks, it would be like as if you're driving a car without your speedometer, without your gas gauge, and without any of the information that tells you how to get from point A to point B. So the Greeks are critically important. But what I'm going to talk about now are just the Greeks that we need for this particular kind of strategy I'm talking about. Okay, so the first of the two Greeks, delta and gamma. Delta, the general definition is that delta is a change in an option's premium relative to a 1-point change in the price of the stock. Okay. Now, a more mathematical definition is that delta is the first derivative of an option's premium relative to a change in the price of the stock. Okay, so the general definition, which is what we'll use. There's a more mathematical definition, which I won't talk about that anymore this afternoon. Then we have gamma. The general definition of gamma is that gamma is a change in an option's delta relative to a 1-point change in the price of the stock. So gamma doesn't talk about a change in the option premium. It just talks about a change in the delta. Mathematically, it's the second derivative of an option premium relative to a change in the price of the stock. Okay? Basic definitions. The other Greeks, theta is a change in the option premium relative to a change in time to expiration. Vega is a change in the option premium relative to a change in volatility. And rho is a change in the option premium relative to a change in the risk-free interest rate. All right, now, just as far as notation goes, both delta and gamma are percentages. So if we're talking about one option, we could refer to it as 85% or 0.85. Normally, when I'm referring to a delta or a gamma, I'm thinking in terms of an option contract. Now, since an option contract represents, most of the time at least, represents 100 shares of stock, I'm going to multiply the delta by 100 and move the decimal point 2 places over to the right. Okay, so I'll talk about an 85 delta as opposed to a 0.85 delta if we're talking about an option contract. All right? Okay, so some basic information about call deltas. Call premiums increase as the price of a stock increases, so call deltas are positive. Deep in the money calls have deltas of approximately 100, and they act like long stock. Now, when I say approximately 100, an option could never move as quickly as stock. Maybe to 2 decimal points it can, and that's really all we could go. But just on a theoretical basis, the rate of change of an option is never as fast as the underlying itself, or the stock. The at-the-money, ATM is at-the-money. The at-the-money calls have deltas of approximately 50. When there's more time to go to expiration, the delta increases for the at-the-money. So if we had a month to go, it might be 52 or 54. Depends on volatility and interest rates to some degree. Far out-of-the-money calls have deltas of approximately 0. And the same type of comment that I made for deep in the money calls, we'll say for out of the money calls, and that is it's never really exactly 0. You know, to 2 decimal points it is, and that's all we really care about. But just on a theoretical basis, it's never really 0. All right, and then short calls, if we're selling a call, they will have negative deltas. Right? And puts, we'll talk about puts. Oops. Yeah, here we go. So we're going to talk about puts now. So put premiums decrease as the price of the stock increases. So the put deltas are going to be negative. Deep in the money puts have deltas of approximately minus 100. It's going to act like short stock. At the money puts have deltas of approximately minus 50, negative 50, and far out of the money puts have deltas of approximately 0. Short puts have positive deltas, okay? So puts have negative deltas. If we're shorting a put, we're going to end up with a positive delta. I know for some this might be a basic review, but it's going to get a little more intense as we move on, okay? So here we have the delta of stock and the gamma of stock. So delta of long stock is always 100. Delta of short stock is always minus 100. Gamma of long stock, some people say NA, but we could really say 0. Remember, the gamma is the change in delta. Well, if delta is always 100, then the change is going to be 0. Well, when the stock price changes, we go from 100 delta to 100 delta, and so we could call it 0. I think a lot of people would refer to it as just NA, though. Same thing with short stock. The change in the delta is going to be 0, or we could refer to it as NA. A question that I'll ask my mentoring students sometimes, what's the delta of cash? I get interesting answers on that. Think about it. I'll tell you. Well, the delta of cash is actually 0, or we could say NA. And the example that I use is, suppose we have IBM at 150 or something like that, and we have $1,000 in the bank. And then IBM goes up $1. How much money do you have in the bank? Well, we still have we still have the same amount. There's no impact. And there's a reason why I asked that question, particularly if you're trading OEX options. But that's another topic that we could talk about sometime. All right. Here's the relationship between the put and call delta. The call delta minus the put delta. Now remember, the put delta is negative, so we have minus a minus, has to equal 100. Okay, call delta minus put delta equals 100. And the relationship between the put and call gamma, well, that's very easy. They're equal to each other. Call gamma equals put gamma. Okay? All right, now how does delta work? Well, if P is the option premium, I'm making a formula for you to make it easy to calculate manually. So if P is the option premium, and D is the delta, and M is the stock movement, positive for an increase, negative for a decrease, if nothing else changes, just a change in the stock price, then the new option premium is going to be calculated this way. Premium new is equal to premium old plus the delta times the amount of movement. The only, well, I guess there are several ways people could have trouble with this, but the way that I've seen people run into problems is by not observing the signs of D and M, because either the delta or the movement could be positive or negative, and I think this group knows a positive times a negative number is negative, and a negative number times a negative number is positive. Okay? So here's some examples of delta for calls, just so you get a sense of how it works, how to apply the formula. So if we have a stock at 37.50 and the Jan 35 call, let's say, is $3.75 with the delta of 70, well, here's the calculation of the new premium as the stock price changes. So if the stock went down $1 to 36.50, we take the 375, the old premium, plus 0.70, the delta, times the amount of movement. So 0.7 times minus 1 is minus 70 cents, giving us a premium of 305. If the stock went up 20 cents, then we have a positive 0.2 in here, positive 20 cents, and we get a new premium of 389. And if the stock went up 50 cents, we just put a 50 in here and add 35 cents to the 375. Okay? For puts, here we just have to be a little more concerned about the signs, because we have the same type of example. The stock is 37.50, the Jan 35 put, let's say, is 90 cents, and the delta is negative 30. So now if the stock goes from 37.50 to 36.50, down $1, we take the old premium, 90 cents, plus 0.30, the delta, times minus 1. So we're actually adding 30 cents to the 90 cents and coming up with $1.20. Okay, same. We work the same way for these other prices. At 37.40, we're down 10 cents, so the premium is 90, comes out to 93. And at 38, we're going up 50 cents, so we're multiplying 50 times negative 0.3, or 15 cents from 90, leaving us with a new premium of 75. Okay? All right, let's keep going. All right, now how do we change the delta of a position? Let's say you have a particular position on. How do we make the delta of the position more positive? Well, there's really three ways. We could buy stock. We know that always has the 100 delta per 100 shares. We could buy calls, or we could sell puts. These are three ways to make a position, to give a position more positive deltas. Okay. How do we make a position more negative deltas? Well, we could add negative deltas to a position by selling stock. And if we don't own the stock, obviously it would be shorting the stock. But selling or shorting stock, buying puts, or selling calls. Calls have a positive delta. When we sell them, it adds negative deltas to the position. Okay? All right. Now, how does gamma work? Well, we have a formula for that as well. D is delta. We'll call gamma G, and M is the stock movement. Again, if nothing else changes, then a movement of M, we calculate the new delta this way. The new delta is equal to the old delta plus the gamma times the amount of movement. Same issue, just when you're using it, be careful to be sure that you're applying the signs correctly. Okay. I have an example here, or a couple of examples. So example of gamma for call. So we have the stock at 37.50. The Jan 35 call is 375. The delta is 70, and the gamma is 4. So what we use gamma for is to calculate the new delta. So our new delta, if the stock goes down $1, we multiply the 0.04 gamma by -1. Added to 70 is 66. If the stock went up 20 cents, we'd end up with a new delta of 0.708. It would be, most of the time you just see it as 71.71, but I wanted to show the calculation. And if the stock went up 50 cents, this is how we do the calculation. Our delta would go to 72. Okay, and I think there's one more example. Yeah, same kind of example with puts. So we have the stock at 37.50. Notice the gamma is the same as it was for the calls, but the delta now is 0.30, -30, and we just apply the formula the same way. So with the stock going down, the delta goes to -0.34. With the stock going down only 10 cents, the gamma would go to -0.304, or -30 cents. And with the stock going up 50 cents, we calculate the new delta as -28. The -30 that we're starting with, the -30 delta plus 0.04 times 0.5, or 1/2. That's 2 cents, or it's really 2 deltas. From 30, -30 plus 2 deltas will give you -28 deltas. Okay, so that's how it works if we're going to do it mechanically. Most of the time, I imagine we'll look at the TradeStation platform and see what our position is, what the Greeks are. Here's how to combine deltas and gammas. The truth is, this is the same way that we would combine the other Greeks as well, theta, vega, and rho. I'm just talking about delta and gamma right now, so that's what I'm reflecting over here. So if I had a position, and please don't read anything into this position, it's a made-up position just for this webinar. So if I had a position, if I'm long 10 of the Jan 35 calls with a delta of 60 and a gamma of 7, my position delta for that would be 600 deltas, the 10 that the 10 contracts times 60 deltas, or 600, and my gamma is the 10 times 7 for 70. I'm also short 8 of the Jan 30 puts. The puts have a delta of -25 and a gamma of 3. So when I multiply -8 by -25, I get the delta of the Jan 30 puts, of the 8 short Jan 30 puts, as +200, and the gamma as -24. Okay, do the same thing. I'm long 10 of the Feb 40 puts. They have the negative delta. Notice the gammas are positive, whether we're talking about calls or puts. What will change that is if we're long or short the option. So right above here, we ended up with negative gamma for the Jan 30 puts. But now for the Feb 40 puts, we're long 10. So +10 times 4 is 40 gamma. And when we add them up, we see for our position, we're long 300 deltas, and we're long 86 gamma. This position, and what this means, sometimes I refer to the delta as ESP, equivalent stock or equivalent share position. The position will act like 300 shares of stock over a small range. Now, why is it over a small range? Because the deltas don't stay where they are. The gamma is going to move the delta, right? So it's only over a small range where we could say this particular position would act like 300 shares of stock. All right. Now, well, we'll talk about delta neutral, but I'll just tell you now, if I sold 300 shares of stock, what would my delta be? It would be 300 minus 300, or 0, and that's a delta neutral position. But we'll get there. All right. So, well, we're there. That was quick. Okay, so the definition of delta neutral. For our purposes today, we're going to define a delta neutral position this way. It's a position in a given stock where the sum of the deltas of the puts, calls, and stock is equal to or close to 0. Now, generally, when I teach, what I say is for most retail traders, plus or minus 50 deltas is close enough to be considered a delta neutral position. And the reason for that, well, it's several-fold, but first, it's very hard to hit 0 exactly. And second, the calculation of the deltas will be somewhat dependent on the assumptions that you're using, your volatility assumptions, things of that nature. So I might have something that says I'm long 25 deltas, and somebody with the same position on maybe a different platform, or even the same platform with different assumptions, might have their delta showing up as -10. So I always figure 50 plus or minus 50 is pretty close to delta neutral. Now, when I was a floor trader, delta neutral to me was plus or minus 500. Anywhere within that range was close enough to delta neutral. I was a small guy on the floor. I was just trading my own money. Bigger guys might consider delta neutral plus or minus 2,000, 2,500, something like that. So, we could almost say, delta neutral, it's a measure of risk. And we could say, the smaller the delta is, the less directional risk, at least, that you'll have in a position. All right, but we'll talk a lot about that. All right, so why do we want to be delta neutral? Well, it's going to reduce the directional component in the value of the position. The value of the position will not change over a small price range. Now, think about it. The reason that the deltas do change is because of gamma. So what if we had a position that was also gamma neutral? What if the gamma was 0? So it's basically gamma neutral. That would extend the range over which um, the deltas don't change. And we could go even further than that and make a position gamma gamma neutral. Now, by the way, I don't like this term gamma gamma neutral. And it's funny, Larry McMillan and I, we talk about this from time to time. I heard it first from him. And I said, Larry, shouldn't it be, this would indicate to me that it's really a fourth derivative type thing, a second derivative from gamma, second derivative from the second gamma. And he said, no, this is the definition of, of really what a third derivative is. And I said, well, let's check. So I said, okay, we look on the internet for gamma gamma, and yes, they define it the way Larry says. And then we go back a little bit more to say, well, where's this come from? Well, it was Larry who defined it originally. So I kid him a lot and say, well, that might be a little bit of circular reasoning, I think. But anyway, I think this is the terminology that a lot of people use. So this would actually be the third derivative that we'd make neutral. But we're not going to be talking about that. Anyway, taking the directional component out of the equation, that's kind of insurance for our position, and that's going to be an expense, and to some degree that's going to reduce the profitability of the position. So what's the benefit? Why do we want to be delta neutral? Well, let's see. It allows you to isolate one of the other variables, something other than price, that will impact the value of the position. Now, typically, think about this. Option premiums are based on three main variables. We have price, we have time to expiration, and we have volatility. You also have interest rates and dividends, but they're more minor, and a lot of stocks don't have dividends. So I'm not going to talk about them right now, just the three: price, time, and volatility. All right, here's the concept of delta neutral. Price, well, no, I'm sorry. Time is very predictable, right? If there's 30 days to go to expiration today, we know how many days there are tomorrow. And we know how many days there are the next day. So we could very easily predict time to expiration. Okay. Now, if we could take price out of the equation, or at least to a large degree, we're really only left with volatility. And so that's why I consider myself a volatility trader. And the way I think about it is, when volatility is relatively low, I'm a volatility buyer. And when volatility is high, I'm a volatility seller. Okay? So the whole idea of this is really to take the price component out of the equation, so we don't have to predict price. And I'm going to show you how we do it with an example. And like it says here, usually it's volatility that we want to rely on, or to have to predict. Remember, when we're trading, days of arbitrage, particularly for retail traders like we all are, those days are totally gone. Very rare that you'll be able to arb a position. You might leg into some kind of an arbitrage, but you're never going to be able to put one on based on natural pricing, hitting the bid or lifting an offer, something like that. So it's really having to make a prediction. And the belief of a volatility trader is that predicting volatility is easier. Not that it's easy. Nobody's giving away money in this game, but it's easier to predict volatility than it is to predict direction. Okay? So anyway, it's usually volatility, sometimes time, and sometimes, not in today's environment so much, but sometimes interest rates. When I was trading, interest rates were much higher, and they were changing much quicker. So there was something to it, but not in today's environment. We could also use delta neutral in conjunction with gamma scalping. It's a strategy that I teach, but we're not going to talk about that today. That's a whole we could have a whole webinar just on that. And some people use delta neutral for other purposes, such as they want to protect a position for a period of time. In other words, let's say um, that now you might be concerned about what's going to happen to the market over the next X number of days or weeks or a month or whatever, and you might want to make the position delta neutral so that the direction won't impact the position, or at least not very much. And then another would be to take advantage of mispriced options. Nowadays, we're not going to see this, particularly retail traders. We're not going to see this very much. There's a lot of very fast computers out there that whenever a mispriced option gets bid or offered, it gets eliminated very quickly. Okay? All right. So that's why we want to be delta neutral. Now, how do we make a position delta neutral? Well, suppose we just have two options. All right, we have the Jan 50 call for $3. We have a delta of 60 and a gamma of 8, and we have the Jan 40 put at $1.10 with a delta of negative 25 and a gamma of 4. All we have to do is form the ratio of deltas. So I take 60 over 25. Don't have to worry about the negative sign here. I get 2.4, and what that means is we have to buy 2.4 puts for every call. So in this case, we can't buy fractions, of course. So we could say, all right, how about we buy 12 puts for every 5 calls. Now let's take a look at the numbers. All right, so here's one thing we could do. We could buy 5 calls for every 12 puts and take a look at what our deltas would look like. For the calls, we'd have 300 deltas. For the puts, we'd have negative 300 deltas. So our delta position is 0. That's pretty delta neutral, right? Our gamma position is going to be 5 times 8. That's going to give me my 40. And 12 times 4 is 48. I'm going to have a positive 88 gamma. Now, notice there's lots of ways we could make a position delta neutral. What if we went the other way and we said, all right, I'm going to sell 5 calls for every 12 puts that I sell? Well, now the delta of the calls would be negative 300. The delta of the puts would be positive. And again, I'd have a delta neutral position. But notice now my gamma is negative. I'm not going to go into the difference between trading positive gamma and negative gamma, but it's very different. Okay? And here's even a third way. There's lots of ways we could make a position delta neutral. In this case, I'm going to buy 5 calls and 8 puts. I'll get 300 deltas from the calls. I'll be short 200 deltas from the puts. And so if I short or sell, depending on what my position is, but if I sell 100 shares of stock, again, I'll have a delta neutral position. And you could see my gamma in this case is going to be positive 72. Now what I'm not showing is the theta and vega that we're going to have in each of these positions. They'll be different as well. Okay, so there's a lot that goes into determining what kind of position that we want. Right now we're just concentrating on making the position delta neutral. Now let's see what else we could do. We could also make the position gamma neutral. We want it to be gamma neutral and delta neutral. Remember what I said before. If we do that, we're going to have a wider range where the change in value of the underlying, change in stock price, won't impact our position. So how do we do something like that? Well, the first thing we're going to do is neutralize the gamma. And again, we could do it the same way. We could form a ratio, right? And in this case, we could, oh, excuse me, we could buy 10 of the calls and sell 20 of the puts, and that's going to give me 80 gamma and negative 80 gamma. So my gamma position is going to be 0. Now remember, shares don't have any gamma, or or 0 gamma, right? So if all I did was buy the 10 calls and sell the 20 puts, I would be long 1,100 shares, 1,100 deltas, right? ESP, equivalent stock position, 600 and 500. So what I do is I sell 1,100 shares. Now I have a position that is both gamma neutral and delta neutral. This will remain, this will act as um, this will act as 0 shares of stock, and so it won't change its value as the stock price goes up or the stock price goes down. Now somebody might say, well, if you have a position and you're not going to make money if the stock goes up, you're not going to make money if the stock goes down, why are you doing it? Well, remember what we said before. We're focusing on perhaps volatility or perhaps time. We're focusing on one of the other variables, but we've taken price out of the equation. Okay? Now, another way to do it, you could see, and there's lots of other ways as well that we could do this. But here I'm selling the 10 calls, buying the 20 puts. That again gives me a 0 gamma position, leaves me short 1,100 shares. So if I buy 1,100 shares of stock, I'll end up with a delta neutral position. Okay, so this is all how we make a position delta or gamma neutral and delta. Then I have an example. This is pretty neat, but I'll go through it quickly. So I have a position. Again, don't read anything into it. It was just made up. I'm long 6 November 50 calls. The premium 6.25. The delta is 80. And so the value of my position, the delta value is 480, and the dollar value is 37.50. That's what it would cost to buy 6 of these calls. Then we have, I'm short 4 of the Jan 45 puts at 210. Here's the delta. Notice the delta is positive, but I'm using a negative sign for the credit. And then I have short 600 shares of stock at 55. And so that would be negative 600 shares, negative 600 shares, which would give me negative 600 deltas for a total delta position of 0. And I'm short $33,000 for a net position of negative 30,090. All right. Now, what I'll do up here, I'm going to see what happens as the stock goes up 50 cents and as it goes down $1. Okay, so let's look. All right. Well, I'll put them all up so we could see it all at one time. All right. So if the stock went up 50 cents, the November 50 call, which was $6.25 with a delta of 80, that if you remember the formula we had, we're going to multiply 0.5 times 80. That gives me 40 cents. Added on to the 625, it gives me a total premium of $6.65. So I calculate the dollar value and the gain or loss. The gain or loss is going to be positive, a gain of $240. I paid $37.50 right up here, and now it's worth $39.90. So that's a gain of $240. And you could do the same thing. I'll do one for the puts. For the puts, what happened? The stock went up 50 cents. So what we have to do is multiply 0.5 times negative 30, right? That gives me negative 15 cents added to the 210, or $1.95. So the dollar value now, this is, remember, I'm short these. I'm short 4 of them. Is $780. And there's a gain of $60. In other words, I sold something for $840 over here, right? And now I could buy it back for $60. I'm sorry, for $780 for a gain of 60. Okay, and then the stock, we're short shares of stock. We're going to lose $300. And so when we look at the dollar value, notice this. It's $30,090, just like it was over here. And my gain or loss in total is 0. Okay, and you could work through the numbers. Um, you'll end up coming up with the same thing over here. We end up with the stock going down $1. Well, excuse me. With the stock going down $1, we're still going to end up with the same dollar value of our position, negative 30,000, and a gain or loss equal to 0. Okay. Now remember, the reason we put this position on is we were focusing on something other than price. But as far as price goes, it didn't impact us. Now, this is a very nice example, but in reality, the deltas are going to change. So it might not come out exactly to 0. The value of my position might change a little bit, but if this was gamma neutral as well, that would be pretty close to exactly what we're, to what we're talking about here. All right. Does it work? All right. Well, here's an example. Personally, I happen to trade earnings a lot because here's my theory on that. I believe that there are very few things that we could say, if this happens, then that will happen. But one of the things that I can say with, I don't know, 98% of the time confidence, something like that, very high confidence level, is that when earnings come out, after an earnings announcement, the volatility of the options will decrease. Okay? I don't know if the stock will go up or down, but I do know, I'm pretty sure, that the volatility will go down when earnings come out. Okay. I also, obviously, I know the timing issues. I know how many days there were yesterday. I know how many days there are today. All right. So here's an example that I put together. It's a made-up example, but it's based on a situation that's very close to real life. I made the numbers work exactly, but it was a real, pretty close to a real example. So we have a stock at 53, and in this particular situation, volatility normally trades between 35 and 55. And earnings are coming out tomorrow, and if we look at the options, the volatility is trading higher than the high end. The volatility is trading at about 60. Okay, so the Jan 60 call at $2.27. The delta is about a third, 33.3. There's 50 days to go, and the risk-free rate. And the reason I have this is because sometimes people put it into their own calculators just to look at my numbers. But the risk-free rate I used was 1%. Okay, that's pretty close to what I use today for real trading. But anyway, so what I want to do is put on a delta neutral covered call. So what I'm going to do is I'm going to buy 100 shares of stock at 53. So the position delta, just 100 shares, will be 100, and the cost of this will be $5,300. And in addition to that, I'm going to sell 3 of the Jan 60 calls at 227, and we said the delta is equal to 33.3. So my position delta minus 3 times 33.3, I'm going to say that's 100 minus 100. So this is a delta neutral position, right? It's equal to 0 deltas. And the cost, or the credit I'm going to take in for selling 3 of these Jan 60 calls is $681. So the total cost of this position is $4,619. And yes, I know there's going to be a margin requirement, but this is collateral margin. It's not, we're not borrowing anything. We just need money in our account to be able to put this position on. Okay, so let's remember this: 0 deltas and a cost of $4,619. Okay, next day, earnings are released and volatility drops to 50. And that's not even much of a drop. I didn't want to make this seem too dramatic. Sometimes you could have a volatility of 60 and it could drop to 30 or something like that, or it could drop a lot. But here we're going from a 60 vol to a 50 vol. Now remember, we paid $46.19 for this position yesterday. So here are various stock prices, 45, some odd price, 47.68, and then dollar prices, 49.50, all the way up to 57, then another odd one, 60.84 and 61. Here's the change in the stock price, the percentage change in the stock price. So here's the value of the stock, and here's the value of the calls based on a 50 vol and 1 day left to expiration. So the position, this is the value of the position now. And remember, we paid $46.19. So if the stock drops that 15%, we're going to lose $191. That's a pretty big drop, though, 15%. The break even, that's why I have the odd prices for the break even. If the stock drops 10%, I don't know if it's exact, yeah, pretty close to 10. It was 53, right? So yeah, almost exactly 10, a little bit off. But the break even amount is a drop of 10%. Anywhere of less of a drop than 10%, there's going to be a profit. Okay, so we could go all the way to 53. Anywhere between 53 down to 49, or actually down to 47.68, there's going to be some type of profit. This does not include any kind of commissions, of course, right? Okay. What if the stock goes up? Well, if the stock goes up, take a look. We don't run into trouble until the stock goes up 15%. So the stock could go up all the way up to 15%. 15% would be break even, 60.84, we'll call it, or 61 exactly. We could see at 61 we're going to lose 10 bucks, but at 60.84 that's exactly break even. 46.20 we paid 46.19. So so this is pretty neat, and this is the whole concept of delta neutral and how it works. But is it guaranteed? Well, what are the problems? Well, first, the stock could move too far, right? We saw with the example that I had, we could move 10% one way, 10% down. We could move 15% up. Volatility might not come in enough. You know, maybe it was 60 and the volatility just stayed very high. It's possible, although we said, you know, in that particular stock, I think volatility traded from 35 to 55. Worse yet, volatility could increase. Now, let me just talk about that. The times when that would happen, generally, you know, anything's possible when we're trading, right? We all know that. But generally, that might happen if the stock takes a really big dip. If there's a huge movement to the downside, volatility might not come in. It might stay where it is, might even increase a little. But over a few days, typically, within a few days, volatility will come back to its natural trading range. So the situation in that case might be we have to hold the position a little bit longer, okay, for volatility to come in. Otherwise, we'll lose to volatility and we'll lose to direction. So, excuse me. Okay, and you know, the options might just not behave as they should. It might be that other options within the series are the volatility drops, but the particular one that you sold, the 60 call in my example, for whatever reason, might stay high. Another problem might be we might lose to time decay. That's not in this particular example. You know, we're short options, so selling, so time decay is working in our favor. But just in a more general case, that could hurt us if we have a different type of position on. If the size is small, you know, then you might have commissions and other expenses that eat away at the profit. And then we have the margin requirements, which which could be onerous to some if there's not enough money in your account to cover those margin requirements. So those are some problems that you could face when you're trying to use this type of a strategy. And what else? Now, okay, what I wanted to talk about, the position that I put on, that I was showing you, buying 100 shares at 53 and selling 3 of the Jan 60 calls at 227 had a total debit of 46.19. Well, if you're familiar with synthetics, and again, it's one of those topics I can't talk about it today because I could I could talk for an hour easily about synthetic positions, but that position is synthetically equivalent to this position. In other words, just selling one Jan 60 put at 919, that was my calculated value of what the 60 put would be, and selling 2 of the Jan 60 calls at the 227, and in that case, we'd receive a credit of 1373. Now, in synthetically equivalent positions, we should make or lose the same dollar amount. So if I make $200 on this debit position, well then I should make $200 on this credit position. I should make or lose the same amount. Obviously, the percentage is going to be very different, right? Here we have a debit of 4,600. Here we have a credit of 1,300. So we'd have to do different calculations as far as the percentages go, but the dollar amount should be the same, or at least very, very close. Theoretically, it should be identical, but in practice, things might be a little bit different. Note that if we're doing the credit position, there's going to be a margin requirement, but we also have the margin requirement even with the debit position, right? We're shorting. 2 of these are naked short. 2 of these calls are naked shorts. So, but the point is that if you're looking at a position and for whatever reason, you know, the debit might be something that you're not willing to put out, you might want to look at a synthetic equivalent to that position, which will give you the same gain or loss, but a different outlay or a different way of the cash impacting your position. Okay, so all right. So somebody, you know, I'm not really able to look at all the, yes, these are all without commissions. I haven't been able to look at all the questions that have been coming in. Somebody just asked the gamma values would be greater with the synthetic position. No, actually, remember, puts and calls have the same amount of gamma. So we have, basically, we're short 3 of the 3 options on the 60 line. So whatever the gamma is for the put and the call, it's the same times -3. And here we have -3 times whatever the gamma is. The shares don't offer any gamma, right? Okay. Right. Okay, so let me just tell you a little bit about our company, about McMillan Analysis Corp. We provide several things: trade advisories, we do money management, we have educational material, we have software products. And what I do, I do consulting on options to institutions, hedge funds, and individuals. And I guess what I enjoy the most is doing my one-on-one mentoring. And if you're interested, I'll give you contact information. You can always visit our website or call me. I love talking to option traders, so it's never a problem. Here's my direct office line, 973-362-4558. Okay, now, and yeah, the mentoring program, you know, there's something that I recently implemented that's really kind of neat. It's called our tuition reimbursement program. Students who are enrolled in our mentoring program will receive either discounted or rebated commissions, about 20% from our recommended brokers until the cost of the mentoring is recovered. And it's really, you know, everybody wins with it. It's really pretty neat. It's a win for the broker because they get trained customers who want to trade options, and you know, hopefully we'll be successful doing it. It's a win for us because we could get more students, and it's a win for the student because if they trade enough, they're going to get the mentoring basically for free. when I say for free, I mean they're paying for it, but then they're getting it back through reduced commissions. So, so it's pretty neat. Um, and obviously, TradeStation is in our tuition reimbursement program, and so this would be available to our mentoring would be available to customers of TradeStation. Let's see. So thank you all very much for spending time with me. If you're interested in the mentoring program, you could visit our website at optionstrategist.com mentoring / mentoring, or just call me. That would be great. 973-362-4558. What else? Yeah. Oh, we do have some specials. Some of our products. We have newsletters. I mentioned that, and educational products. For those who've attended today, they're on a 50% discount. You could take a look at them. Just go to optionstrategist.com / July 17. And oh, I know what we need. Yeah, the answers to the brain teasers. Um, Here they are. The man in the portrait is the son. Number 2 is true. Harry's the best trader. And number 3 is 22 times. If you did enter and if you were a winner, I'll let you know by mail. Actually, if you did enter, I'll respond to you whether you won or not. I always respond to emails I get. I think, yeah, that's it. I'll leave my contact information up. Thank you all so much for attending.